Hey guys, this is your host Nitin Binhani, and a very warm welcome to my startup podcast channel Jazair Audio, where we share real stories with real learnings.
Today, we're tackling a story that sent shockwaves through the food delivery industry: DoorDash's proposed $3.6 billion takeover of Deliveroo. We'll break this down in 5 parts, then wrap up with a quick snapshot of where the major food delivery players stand today. Part 1. The emergence of Deliveroo and DoorDash. In 2013, Deliveroo was founded by Will Shue in the UK, where he lamented the lack of late-night food options while working as an investment banker. Today, Deliveroo operates in 10 markets worldwide, including the UK, Ireland, France, Italy, UAE, and went public in London in March 2021 with a peak valuation of $10.1 billion. Deliveroo primarily focuses on its Loyalty Plus subscriptions and grocery market. Also in 2013, DoorDash launched in the US, and it has since expanded to 30-plus countries, including Canada, Australia, New Zealand, making it one of the big 4 global food delivery platforms. DoorDash focuses heavily on data analytics, with a strong D2C focus. Both platforms rode the pandemic wave to rapid growth. However, as dining restrictions eased, investors began demanding profitability over expansion. Then suddenly, on April 5, 2025, DoorDash made its move: a formal proposal to buy all publicly traded Deliveroo shares for 180 pence each, valuing the deal at $3.6 billion. Deliveroo's board has indicated it would likely recommend this offer to shareholders, provided the final terms align. The bid deadline is until May 23, 2025, post which DoorDash must either make the offer firm or walk away. Part 2. Strategic rationale behind the deal. Why would DoorDash pay top dollar for a company whose shares have languished about 50% below their IPO price? Well, it basically comes down to geographic expansion, operational synergy, and scale economics. Let's cover these in details. A. Access to new markets. Deliveroo's 10 European and Asian markets are almost entirely complementary to DoorDash's existing footprint, giving latter instant entry into regions where it has minimal presence without antitrust headaches. B. Proven local playbooks. Deliveroo's branded loyalty program, Plus, and grocery delivery partnerships demonstrate models that DoorDash can roll out globally. Analysts at Jefferies note that DoorDash's growth strategies in the US could easily be applied to Deliveroo's markets to drive faster user base expansion and free cash flow growth. C. Operational efficiencies. Combining the two platforms could yield cost savings in tech development, fulfillment logistics, and marketing, while also consolidating supplier negotiations and rider recruitment. D. Financial discipline. Deliveroo paused a $133 million share buyback following the approach to conserve cash, signaling readiness for a strategic shift toward shareholder value. In short, DoorDash is betting that scale and diversification will win the next phase of food delivery. Part 3. Other food delivery apps include A. Uber Eats, operating in 45-plus countries, with the benefits of integrated ride-hailing and bundling. B. Just Eat, operating in UK, Italy, Scandinavia, with focus on white-label options. C. Foodpanda, primarily operates in Germany and Southeast Asia, focusing on dark kitchens, with retail media partnerships. With consolidation now accelerating, each player now faces the same question: do you scale fast enough to compete or specialize deeply to survive? Part 4. Risks and challenges. No big deal comes without big hurdles. Here's what could trip up the combined giants deal. A. Integration complexity. Merging teams across 10 countries with varying labor laws and rider classification rules is a massive undertaking. Cultural alignment will be critical, especially given Deliveroo's public fights over gig worker pay and classification, an issue that prompted a voluntary wage agreement with UK trade unions in 2022. B. regulatory scrutiny despite complementarity. While sources say this deal faces no regulatory hurdles in Europe due to minimal market overlap, antitrust authorities could still probe labor market impacts or data sharing concerns. C. Market backlash. Consumers and restaurants worry that consolidation reduces choice and bargaining power. If pricing and fees rise post-merger, it could drive users back to niche local players. D. Execution risks. DoorDash's track record includes an $8 billion acquisition of Wolt in 2021, but that all-stock deal came with its own integration challenges. Any stumble here could spook investors and riders alike. Part 5. Implications for the food delivery landscape. This potential mega deal is more than a headline. It's a wake-up call for the entire sector. Here are the key reasons. A. Consolidation accelerating. Food delivery apps are shifting from rapid expansion to consolidation. From Uber's purchase of Postmates in 2020 to Process's $5.45 billion deal for Just Eat Takeaway in February 2025, the message is loud and clear. Survival now depends on either scale or deep specialization. B. Profit over presence. Global food delivery gross transaction value (GTV) growth has slowed considerably. Southeast Asia saw just 5% growth in 2023 versus 41% in 2021, prompting tighter margins and operational discipline. Deliveroo's recent exit from Hong Kong after 9 loss-making years amid fierce competition and rising costs underlines a pivot to core profitable regions. Foodpanda will exit Thailand by May 2025. It consistently struggled financially, accumulating losses of $399 million between 2019 and 2023. Delivery Hero similarly abandoned talks to sell its Foodpanda Southeast Asia unit in February 2024, choosing to refocus on markets where it can drive profitability. In Southeast Asia, the super apps often dominate the market, or hyper-local players win with deep cultural and consumer understanding. C. Technology as a differentiator. The next battleground will be AI-driven route optimization, predictive ordering, and integrated grocery and non-food logistics, not just fastest delivery. Looking ahead, we're likely to see more of such mega mergers, joint ventures, or partnerships as platforms chase profitability and defend against new entrants. Folks, that's it for today. Thanks for tuning in. Please like, comment, and subscribe to the channel. Join us next time as we continue exploring the dynamic world of startups and the valuable lessons from their journeys.